A warm welcome to MarketPulse by SC Securities and Daily FT. I'm Dilusha Gamage, and today I'm in the conversation with Mr. Hasita Liyanage, the Head of Research of Capital Trust. Hasita, welcome to MarketPulse.
Thanks, Dilusha.
Hasita, to start off the conversation, now it's no doubt that we are going through a very unprecedented, challenging time. And the investor community is quite worried. And they are going through their portfolios, they're seeing the portfolio value is coming down, the market is coming down. So what is the way forward for the investors from now onwards?
Yes, as you correctly mentioned, we're going through unprecedented times, both on the economic front as well as on the social front, with loads of social unrest, etc., due to increase of cost of living. So we need to step back and get back to fundamentals in terms of understanding the market dynamics. So if we look at the macroeconomic front, yes, there's quite a lot of investors who are wary of the unprecedented increase in policy rates on the 8th of April. So obviously, when that happens, there's a shift away from equities to risk-free assets in general. But what we also need to account for at the moment is the increasing inflation with the 67% depreciation of the rupee after the currency was floated on the 7th of March. That has really led to inflation gathering pace. So I think in March, the CCPI was 18.7%, if I'm not mistaken, whereas the NCPI was 21.5%. Since then, in April, the currency had depreciated to 340. Fuel prices have been increased substantially. So these will lead to high inflation in April. So what is the central bank doing about that? T-bill rates have gone up to 24.36 at the last auction on the 20th. But at the same time, central bank took a decision not to accept bids above 25%. So in their views, it might be an overshoot of some extent above 25%. So they'll try to manage T-bill rates at 25% until inflation increases officially. So then we as equity investors have to figure out exactly what sort of strategy to adopt. Are you going to move away completely from equities into fixed income? To understand that, you need to look at real interest rates. So if you account for T-bills, there's an 18% tax applicable on that. So your T-bill interest rate net of taxes is around 20%. So depending on the CPI or NCPI indicators you'll use, real interest rates will be negative or marginally positive. It's not really significant. So then you can adopt a couple of strategies. One is capital preservation, move away from equities, or the other option is in the short term, and then move into equities in a longer term horizon. But what would be a sensible investment strategy is to look at accumulating stocks that are currently really mispriced. So if you look at the CSE index itself, since the 19th of January high, the index has come down close to 40%. That was before today's close, where I think the SPI is down 7 or 10, and S&P is down 12%. So accounting for this is a very drastic reaction the CSE has had. So saying that really attractive stocks that are linked to dollar income, where the revenue has increased by close to 70% because of the depreciation, the net profit will increase accordingly as well, and various other sectors like real estate, counters that have substantial built-up real estate, because in the inflationary environment, the building material prices go up, and then your replacement costs on built-up real estate is much higher. So there's a positive impact on net asset values. There are certain counters that will outperform the broader index and provide protection to investors from this macroeconomic turmoil that we're facing at the moment. So value investors and should take this opportunity to pick up these counters that are trading at extremely low PEs. Certain counters are now trading below 3 PEs with high liquidity and very high growth. And some counters are below 4 now, some of these other positive counters. So it's a good opportunity to realign your portfolio, move away from various other counters that are negatively impacted to these positively impacted counters and build a longer term or medium term strategy in terms of equity.
So what would be the specific counters, if I may ask?
So looking at specific counters, if you look at the top 3 liquid counters, Expo, Bill, and LOLC, all 3 are positively impacted in terms of dollar earning companies, companies that have foreign operations because there will be translation gains coming onto it because these foreign operations will be revalued. The revenue will be much higher now. So if you look at the intrinsic value of these foreign operations will increase. As well as these counters all provide protection against the expected increase in fiscal rates. Because, for example, exposure to Sri Lanka is very minimal. I think they have carried forward tax losses in Sri Lanka. So even if taxes go up, it won't have any material impact on their bottom line. Again, LOLC will have a very significant deferred tax asset. So even if interest rates go up, they won't be impacted. Bill, again, has carried forward tax losses. So fiscal changes expected won't really impact them in terms of a bottom line reduction. Whereas on the USD, on the currency depreciation, and their real estate portfolios will be revalued. So there are quite a few benefits. So accounting for all of these, I think in terms of P's, they are trading below 4 after today's drop in terms of FY22 earnings. So these are unprecedented multiples we're talking about, between 2 and 4 for these really liquid counters that are growth counters that will protect investors in terms of earnings, accounting for the Sri Lankan turmoil, for example.
And also, Mahesh, now looking at the macro factors, so the IMF discussions have already started and we are going through the process. So how would these developments would affect the capital market?
Okay, very interesting question. So looking at that front, so on the IMF front, we have already taken certain measures. We have already implemented a flexible exchange rate, where the exchange rate has depreciated 67% to date, and interest rates as well. We have a market pricing mechanism in place where the interest T-bills have gone up to 24.36%. But in terms of additional reforms that the IMF requires, the restoration of debt sustainability, I think the RFP closed on Friday, and advisors will be appointed next 2 weeks, and they will start the debt restructuring and negotiations with multilaterals, bilaterals, as well as with the ISB bondholders, and then look at whether SLDBs will be restructured as well, although the banks are canvassing not to. So these reforms are going to create another shock in terms of the financial systems, increase in exchange rates, increase in inflation, social unrest, political instability, etc. So these sort of circumstances are completely new to Sri Lankan investors and citizens, but these are not new phenomenons globally. So if you look at countries like Argentina, Zimbabwe, Venezuela, etc., they've all gone through these turmoils. So exchange rates have depreciated quite a bit. There have been social unrest due to the unavailability of essentials. Policy rates have gone up considerably. So the common feature across these markets is when this happens, there's an initial sell-off. So it happened in Argentina, it happened in Zimbabwe, etc. There's an initial sell-off, but then there's a move away from equities into fixed income when the policy rates goes up. But inflation is increasing as well at the same time, and the investors get used to a high interest rate environment, and they look at real interest rates again. So when real interest rates are negative or marginally positive, it's not sufficient. They look at, okay, how they can go about building retaining wealth in dollar terms. So they move into equities. And all these markets, one common feature is the equity markets have provided that protection. The equity markets have outperformed currency depreciation. The equity markets have outperformed inflation. So I think Sri Lanka should take cue from such markets that have gone through this whole debt default sort of scenario, and look at how the economic conditions change and how investors can use those examples to protect their wealth. And equity markets finally, I think, will provide that asset class for provides you the liquidity, it provides you that protection against inflation and currency depreciation.
And also, how would you look at this sell down that we have been experiencing for the last 2 months? How will the trend continues?
So, okay, so we've been analyzing the various social and various other reasons why the market has dropped 40%, or after today dropped more than 50% over the last couple of months since January 19th. So what really happened was, I think around the 25th of January, the PUCSL agreed, basically gave permission for the CB to implement power cuts. So initially, just going back one step. So initially the market came down after we settled the bond, 500 million bond. There was fears of debt default for the July bond. And the low reserves, reserve position, there were fears on that. So the market came down, I think, around 8% initially. Then the PUCSL announced power cuts, and there were power cuts from 8 to 13 hours. So this really caused fears of business continuity, fears on low productivity, affecting companies' bottom lines. So this resulted in, I think, around a 16% pullback on the index. But since then, now Sri Lanka was lucky enough where the monsoon rains came early this year. Reservoirs have filled up 50%. We secured a coal supply until September. So now the power cuts have reduced from 13 hours to around 3 hours. So the 16% pullback that we experienced due to that reason is a bit of should be corrected to some extent because it had overshot to a certain extent for that particular reason. But one of the main reasons the market came down was the social unrest created by lack of essentials, lack of essentials, increasing prices of essentials as well, from fuel, transportation costs went up, food prices went up as a result. So that really caused high inflation, and the cost of living went up quite a bit. So that created social turmoil, where protests started popping up all across the country asking for political change. So when those protests turned violent, then there was a massive sell down as well. The markets came down 9% as well on certain days, and then continued to come down when certain other protests happened. So when the market came down 23% as a result, but at the same time, when there was hope of political change, when the 42 members from the ruling party, I think, moved out and said they will be independent. So that gave some hope to the equity markets of political change. So then what happened was the market picked up 6%. So now we're at a stage where there are rumors that there will be some political change this week, even as early as this week. So if that happens, that might be the hope that certain investors have been waiting for. That might ignite this downward sentiment stop the downward sentiment, and then give some hope to investors, and new money will start flowing in. But one other main reason for the downfall was in anticipation of the policy hike on the 8th of April, the T-bill auction, I think just before that, the policy rates, T-bill rate went up by 323 basis points, if I'm not mistaken. So with that, because they were expecting a policy rate hike. So with that, the market came down 7%. And today was the first trading day after the unprecedented 7% increase in policy rate hikes. So the market came down again because, again, investors wanted to move out, and there was some forced selling created by it, etc. But on the rates, what we have to say is, yes, nominal interest rates have increased to 24.36%. Net of taxes, it is around 20%. But when you account for inflation, depending on which indicator you use, it can be negative or marginally positive. So in terms of providing asset class that will give good returns for investors and preserve your wealth in dollar terms, fixed income won't provide that opportunity. It will help you preserve wealth, but it won't preserve wealth in dollar terms. It will preserve wealth in rupee terms. So if you're looking at asset class that will preserve your wealth in dollar terms, you'll look at equities or certain other asset classes like the coal, for example. So with that in mind, I think people will move back into equities in the taking a medium-term time horizon, investment time horizon, and that will provide you that protection against inflation and depreciation, going by examples such as Argentina, Zimbabwe, Pakistan, etc.
Thank you, Hasita. Thank you very much for joining with MarketPulse. And ladies and gentlemen, you are listening to Mr. Hasita Liyanake, the Head of Research of Capital Trust. And thank you very much for being with MarketPulse.
For more latest news, subscribe to FTTV.